Hello, Jim here. Imagine getting paid to potentially buy stocks at a discount. Sounds crazy? Well, today I want to share with you how you can do just that. I'm an option trader. I've been trading options for a number of years. And one of the greatest tools in the tool chest for an options trader is selling put options. It can actually work a lot better than just buying stocks. Today, I'm going to talk about the strategy I use and how I actually pick up a lot of really good names at a discount, and somebody actually pays me to make the trade. So stay tuned. I think you're going to enjoy what I have for you. Okay, now before I jump into the details, I do want to mention I have several trades that I did last month that are put trades that I'm going to share with you. So stay tuned until the very end and I'll go over these particular trades. It'll give you kind of firsthand view of what it looks like to sell puts. So what is put selling? Put selling is simply the opportunity where you can pick up shares at a discount and someone will literally pay you for that opportunity. Now, how do you go about doing it? Let me just give you kind of a basic example. Say you have a stock you want to own. Well, just to keep it simple, let's just say Coca-Cola. You want to own Coke at $55. It's currently selling at $60. So you can actually go out on this market. It's called the option market. And you can sell a contract saying, I'm willing to buy Coke at $55. And someone will literally pay you some money for that opportunity to sell you those shares. And what's beautiful about it is you can define whatever price you want. They're called strike prices. So you could say, well, I'm willing to buy Coke at $58, $56, $52, and so on and so on. And you can define your own risk. You can also set how long you want the contract to be in play. It can be in play weekly, monthly, 3 months out, 6 months out, 9 months out. So there's a lot of play that you can do to kind of decide, what strike price or what price you want at that particular security, and also, how much risk you want to take. So say you don't end up owning the shares, well, you can just run the contract again the next month. So it can turn into a really nice cash flow, and it can be a monthly cash flow. It can be a weekly cash flow. Or you could say, well, I only want to do this every couple of months. It could be a quarterly cash flow. And it works out really nice. Now, I've been on a journey for a number of years. Originally, all I did was sell covered calls, which is kind of the reverse of puts. If you already own shares, some people will pay you money to buy those shares from you. And again, just like I mentioned about puts a minute ago, you can define what price you want to sell it at, how far out you want to go. Do you want to go out a week, a month, 3 months, 6 months, or even 2 years? That's all I did for a number of years. And about 3.5 years ago, I had a number of contracts get assigned, meaning the shares were sold away from me. And again, it was Coca-Cola at the time. And I really didn't know what I was doing. And at that point, I decided I want to learn more. I want to learn how this works. At that time, I didn't know you could close contracts. I didn't know you could roll contracts. I was really kind of in the dark. One of the first things I found out about was that there was this whole second world of selling puts, and that it can work out really well. So that's kind of how I got into it. And now, having the ability to do that, it's like doubled my opportunity to earn cash and income by selling options. Originally, it was just covered calls, but now it's both covered calls and cash secured puts and what's called vertical put credit spreads or credit spreads, which just means you're limiting your risk. You're like, with a spread, you're not taking quite as much risk. A covered call means you're covered completely for all the shares. A cash secured put means your put is secured by you have enough cash. Now with a spread, you don't potentially have to have enough cash to buy those 100 shares. Every contract when you work in the options market is 100 shares. You just need enough to cover that spread. To give you, for instance, in the same example, if you're selling a spread on Coca-Cola, you may define a $10 spread. So your max loss is that $10 times 100, so 1,000 minus whatever premium you brought in. So it gives you more choices, more opportunities to make money. And then, you can kind of set different risk levels. You can, increase your risk, lower your risk, which is simply just modifying your price. If you want to take less risk, for a put, you want it at a cheaper price. If you want to take more risk, your price is actually pretty close to whatever the stock price at that time. So it kind of opened up a whole new world for me, gave me additional things that I could do that I could not do before. And it actually changed the way I buy stocks. Now, I will still buy stocks on the open market, but I mostly will sell puts for the opportunity to buy those stocks. And if they don't get assigned to me right away, meaning on expiration, if they're what's called in the money, meaning the price of the stock is typically, about the same price of whatever the strike price is. So again, let's use an example. I'm probably losing people, but if you sell a $50 strike, and say Coca-Cola goes below that price, that strike price, then you're called in the money. And if during expiration you are in the money, the shares will be assigned to you, so you own the shares. But the beauty of it again is you picked a lower price. So you originally, instead of just buying the stock in the open market, you picked a lower price, and now you're getting assigned at that lower price. So it really works out well. Now, one thing to keep in mind is, which I talk about this in every video, it becomes critical to choose the right stocks. Pick companies that are good companies. And you might say, well, what is a good company? To me, a good company is a company that's profitable. It's making year over year earnings and improving on those year over year earnings. It has a small amount of debt or no debt. And it's well managed. And you can see that it's well managed because it has really high return on equity and return on assets, meaning the management's putting the assets to good use. And those are just a few of the criteria I like to use to identify companies. I also like to find companies that I use. Again, I talk about Coca-Cola, but Apple, everybody seems to like Apple. I also like Microsoft, Home Depot, all those places where I actually, use their product. It makes it a little bit easier to buy into a stock if you use their products and kind of get a feel for who that company is. At least it's made it easier for me. Now, the key most important piece, or one of the most important pieces, once you've identified that stock you want to own, is identifying what's called the strike price. What price do you want at that? You want that stock. What is the right strike price that makes sense to you? And for me, what I like to do is I like to look at the stock price long term. I'll go back, 3 months, 6 months, a year, 5 years, 10 years, and get a really good look at what's been happening with that stock price and the company in general. And then I typically will pick a strike price that's usually about 10% below whatever the current stock price at the time. For instance, if it's Coca-Cola and it's $60, I would look at, can I get it at 55, 54, something along those lines, about 10% below what the current stock price is. And I will typically then go farther out, meaning they have what's called an option chain where you can see the expirations, you can see the strikes, and I'll show you that one at the very end of the video when I'm talking about the trades. But the farther you go out, the lower the strike price you can have. So to give you, for instance, if you're looking at Coca-Cola and you're going a week out, where you may be able to, if the stock is currently at 60, you might be looking at $58. You go out 2 weeks, well, maybe it's 57. A month, well, maybe it's 55. And you go out 3 months, it may be literally around 52 or 53. So you go farther out and get lower strike prices, which can work out really well. I also like to look at what's called delta, and delta is just what's called a Greek, and it allows you to define how much risk. The same idea, and it coincides just like what I talked about with a lower stock price or strike price. So I like to use what's called a 15 delta or 20 delta. I prefer 15 deltas for puts and 20 deltas for calls. And how that works is a 15 delta is like a 15% chance that you would be assigned, and a 20 delta would be like a 20% chance that you would get assigned, or an 85% chance that you will not get assigned, or an 80% chance that you won't get assigned. So again, it defines, the amount of risk and how far, how big a discount you want. Again, it goes back to my original point. You actually can pick up these stocks at a discount. So it just helps you also with keeping focus. If you're sticking to a 20 delta with whatever particular expiration, you use that same delta, and it can make it easier to determine what strike price you should be looking at. So if you have an expiration that's a week away, you'll see, well, where's that 20 delta? If you're 2 weeks out, 20 delta, where is it? What's that particular strike price? And so on and so on. Now, next, what I find really important is the ability to manage risk. So with actually selling puts, you're not owning the shares from day one. So if by chance something happens and you don't really want to own the stock anymore, you can get out of it. You can potentially what's called rolling, and that's just closing the existing position and opening a new one and potentially going to a lower price. So you could literally roll out and down for a put to hopefully, if you don't want to own that stock anymore, to get to a low enough price that you can get out of the contract. And I've done that before. Sometimes you can't do that if the stock majorly dives. Happened recently with CVS. Then you'll have to make a choice. Well, you're going to get assigned those shares. Do you want to keep the shares or do you want to sell them? And then you can also buy protection. So you could sell a put. I'm willing to, buy this stock. And again, we'll use Coca-Cola at 60. I'm willing to buy this stock at 55, but if it goes below 50, I no longer want it. So you're defining your risk. If it goes below 50 and you've purchased what's called a put, you can put those shares to someone else. Just like you sold the contract for 55, someone else sold the contract for 50. So it minimizes your risk, how big a loss you might take if the market did a major, major dive. So just the nature of selling puts and working with puts gives you a lot more risk management capabilities than just buying the stock. Once you purchase the stock, you are where you are. And a lot of times you're at a much higher price. Now, techniques and tools, again, you can use the option chain. I also like to use Seeking Alpha, I am an affiliate. There's a description in there. They have a lot of nice tools where you can easily see profitability. You can easily see how the dividends look and how the financials look, and even how growth looks and year-over-year earnings. So I found Seeking Alpha really good. I also like bar charts, another good tool. It does more with screening for options, which, if I'm looking for a particular delta, and I also want to look at ROE and ROA and define a pretty structured screen, it'll allow me to do that. So that's another tool you can potentially use. And then I also like with Seeking Alpha, another tool that I've just recently started using, because to minimize the risk, especially with buying stocks, you have to keep track of their earnings. Well, they have a really good earnings calendar that you can use. And I am going to share that with you at the end of this video. Where you can actually see what companies are having earnings on any particular day of the month and plan accordingly. Like, just to give you an example, today Delta actually had earnings. They barely missed earnings. the stock dove quite a bit, but I actually made a trade because now that earnings is out of the way, I got it at a lower price. And I still went out pretty far, so I even picked a lower price. I think Delta dropped from, I think, 46 to 44, and I believe my put option is at 41, so I'm hoping to pick up Delta at 41. Will it make it that low? Well, it might. You just never know. So just a few of the things I wanted to share. And as always, if you're interested in my memberships, take a look at the description. They're getting busier. I've got the 3 levels, the investor level, where you get access to all my trades, my spreadsheets, all the statuses that I like to provide on a daily basis, plus all my collections. I have different videos. I also have, you get access to what I call my Trader Club videos. You don't get access to the actual meetings. That's for the next level, which what I call Traders Club. And that includes, you get the Discord, and then every other week on Sunday around 8 p.m., we have what's called the Traders Club meeting. So usually 20, 30 people will be involved. We'll talk about trading. We'll talk about new tools. Last time we talked about ChatGPT and how you can use it to potentially improve your trading or just help you job-wise. I mean, ChatGPT has become quite amazing. And then I have what's called my coaching club, which is the highest. Now I am increasing the price on that here soon, but not majorly. It's going to go from 25 to 45. But you get 2 sessions each month with me, and I say they're 15 minutes, but they typically last 30 minutes. So you're getting like an hour on a monthly basis. Plus you get access to me on all 3 levels, so you can send me messages through Patreon or Discord. So it may be worth your while. I encourage you to take a look. Again, it's all in the description. So that being said, let's jump into reviewing these trades, and we can dig a little bit deeper as to how to look at these kinds of trades. So let's jump right into the next section. Okay, here are my trades from last month. And these aren't all my trades. These are just my puts. I do have an iron condor in here too. But we'll just go through these. This is kind of a condensed version of my planning worksheet that I provide to my members. And the first trade that I did, which was very early in June, was MetLife. And this is the second or third vertical put credit spread that I've done on them. This trade I did early in June, June 3rd. At the time, I believe MetLife was like 74, 75. I did what's called a vertical put credit spread. So if I had just done a cash secured put, I would have just sold at 67.50. But I also bought some protection of 57.50. So a $10 spread. This was a 30 delta. So I took a little bit more risk, mainly because MetLife is such a good company. And at the time, it was actually, you can see here, it was 71.41, which is pretty good price for MetLife. It wasn't way overvalued by any stretch of the imagination. I went out to an expiration of 9/20, and I brought in $283.30. I paid $352 for selling the cash secured put, but then I bought some protection for $69.35, which that's how I came up with the $283.30. The required capital was $17.16. This was for 2 contracts. So it's literally the $2,000 minus the $283.30 is what capital I had at risk. So my max loss would be the $17.16, and that's what the broker required me to have. And this is like a yearly return of 55%. Now I know this trade is still open, so currently that's what it would be. Once it's closed, it'll be blue, is what I've been doing recently. If I roll it, it'll be gray for this background. So the next is ITB. I also like to do a lot of ETFs. ITB, I believe, is I think it's the Builders ETF. iShares Builder, I believe. And this I did on 625, another vertical put credit spread. I sold a 93 put and I bought an 83 put. This was like a 20 delta for this 93 put, expiring on 8/16/24. Current price was 100, so I was a bit, I was hope to own it at 93, even though it's currently 100. I'd be happy with that 7% discount. It brought in 189.90. And was that one contract or two? No, this was two contracts. So 2000 minus 189.30, which is the 1810.70. And this is like a 73 delta, or not delta, ROI. So it worked out really well. I also like to do a lot of ETFs. I don't just do companies. TPR is Tapestry. They own, what is it, Coach, and some of the other really high-end retail brand names. This was originally 4.4, so this was my only roll. I rolled it on 6.6. Again, a vertical put credit spread, 42.35. So a little bit of a thinner spread, a 7.50 spread, or $7.50. Expiration was 6/21/24 originally. It was 43.49 at the time. And I kept the same strikes and rolled it out where it expires on 8/16/24. And I brought in a total of nearly $600 in premium, but for this roll, I brought in 196.68. So literally about 400 of it is already complete from the prior trade. So the capital required was 1303. So that's the 1500 to 750 times 2 minus the premium. And this was a 77.58 ROI. This one is Tapestry, I believe, is a bit in the money currently. I think it's right around 41 or 42. But again, it pays a nice dividend, a good company. I'm fine with owning it. IWM, this is a Russell 2000. I decided to include this Iron Condor. Now, IWM is one of my only trades that I make where I don't really care to own IWM. There's other ETFs that perform a bit better. One is IJH, and then I think IJR, which don't have the 2000. I think both of those have like 400 or 500 companies, meaning they're typically bigger companies. And what that allows me to do is get a bit of a better return. So I use this income to buy other stocks. But this is one of the typical trades. I've never had an Iron Condor go against me. I have had to roll one at one time, but for the most part, they expire. I don't think I've even had to close one. So this was the put side was 186, 178, and then the call side was 222 and 230. So, and what this allows you to do is you have a pretty high range as long as it doesn't go below 186 or above 222, then it'll expire and you get to keep all the cash. And this was a near a 15 delta, so a 15% chance it would be assigned to me. So I took a little bit less risk. When I do Iron Condors, I can make more premium and I do take more risk. A lot of times I'll do a 10 delta, but rarely do I do above a 15 delta. So this expiration was 8/16, and I have not rolled it yet. So it's this is one I still have currently. I picked up 254.60, and then you typically take one side of the Iron Condor because the Iron Condors, it's a combination of both a vertical put credit spread and a vertical call credit spread. So you don't take both sides. It's either it's gonna go higher or it's gonna go lower. And so that's why it's only 13.45. It's the two spreads, or it's the $8 spread times 200, which is 1,600 minus whatever premium you brought in, which is like a 94% return. And I found for the most part, Iron Condors are, they're typically very profitable. Next is Paycheck. I used to use them. They were my payroll company at one time. I made this trade late in June. Another vertical put credit spread, 115, 105. So I sold the 115 put, purchased the 105. This was a little bit of a higher delta, 33.85. At the time, their stock price was 118. So, and I felt like 118.50, it was more of a bargain. I think their 52-week low was right around 110, 112, something like that. So I will take a little bit more risk if I feel like I could pick up a company at a bargain, and they do pay a pretty good dividend, I believe, too. So 282, so it's 2000 minus the 282.28, and I had a good return, 117% return. And again, these being marked as green, they're still open. So even though I'm saying ROI, these aren't complete trades. At some point, I'll either do better or do worse, and typically if they're assigned to me, then it makes it a lot more complex. But I don't have many assigned to me. I don't think in June I might have had Polaris assigned to me, and that was it. And I think it was only one contract. This is Dominion. I forget what you call it. I think it's trucking company. And I did this one on 618, another vertical put credit spread, 160, 150. Sold the 160 put, bought the 150 put. This was a 19, so just shy of a 20 delta. Sometimes you'll find that you can't get like an exact 20 delta or an exact 15 delta. I believe there was a 19 delta and it may be a 14 delta. And then I wanted more premium, and it was pretty far away. So 160, and their current price was 172. So the strike's quite a bit lower than the 172. I brought in 247, so 2000 minus 247.28, and this was 166 percent ROI, mainly because it's expiring on the 31st. Now I believe it may be I believe I might have closed this, or it's going to expire. I think it's going to expire because I believe it's as high as, it's way over 180 now. So this one will probably expire. So this return is pretty accurate. And the reason it's higher is because, the expiration is a lot sooner. It's 7/19 versus 8/16. So you do really well if you can shorten it, but I typically like to go farther out because I don't want to take as much risk. And again, risk relates to the stock price. And then this was a new one, Chewy, and this was before I forget what you call him, the cat guy or whatever, came out and talking about Chewy. I was already looking at making a trade on them. And I did this on 628, vertical put credit spread, 22.50, 20. They've been on my watch list a long time, and I have not made a trade on them until they make money. I don't trade on companies that don't make money. And now they're making money. So this was a 24 delta. At the time, it was $26. So 22.50 is what I want to own it. It was currently at 25.86. And it's a pretty thin spread, 250. I don't know if you noticed that. So, and I did 4 of them. So I only used $1,000, but I brought in $282.60. And I only need $717 in required capital. But that's what my max loss would be. Because again, the 250 times 4 is 1,000 minus whatever premium. So the most I could lose is $717. I believe it's still about the same price. And it had a 293% return. And again, I believe, it had the fact that it had such a small spread and its expiration isn't too far off is why that came in so much higher. So these, 7 trades? 1, 2, 3, 4, 5, 6, 7 trades. I brought in 1736. I believe for all of June, I did over 70. I think I did 76 or 7,700. I'll have a future video, probably next week, of all my trades in June. But some of the interesting things that I'm doing now is, mainly to risk mitigate, is avoiding earnings. Like I said, I did a Delta trade today, but earnings had already come out. So I ended up making the trade a lot lower than I would have if I had done it before earnings. Show seeking alpha earnings calendar. I'll show that here in a second. And then Delta is set with the first trade and harder to change later. So when you first pick a Delta and you pick a strike, later on, if you have to roll it or manage that trade, it's a lot harder to get, it's easy on the first trade to get the 20 delta, but, if you're in the money and you're trying to, save the trade, it's a lot harder to then go to a 20 delta without taking a significant loss. So that's why on the beginning of the trade, it's like buying a house. You really make your money on that first trade when you first, pick that strike price. That's why that initial strike price is so important. And then better to close than open new position versus rolling. And I need to do better with this. I need to close more of these trades at a certain profit and then later open another position versus rolling. The studies have shown, and what I've seen personally, is you can definitely do better by closing and then opening a brand new position. So let me show you. This is what I wanted to show you is this calendar. They do a really nice job. So like today, I could see, well, Delta was, who had earnings today, and here you can see Delta, and it tells you is it pre or during the market, what the projections are. They do a really nice job, and the yellow dots are if you are watching a company like TSM, Taiwan Semiconductor is another company I do a lot of trades on. So they're coming out post on July 18th. And a lot of my future trades are going to be based on this. Like here's also Abbott Laboratories, which is another really good company. And that's pre, and here's Netflix, I'm not sure how you say that, Novartis AG. We can look at another one here on the 23rd. We've got the big boys, Google, Tesla, Visa, and Coca-Cola. So this works out quite well, and it helps me decide what trades I want to make each week. So that's what I wanted to share with you guys. Let me know what you think, or if you actually do sell puts and how they've worked out for you. So, and as always, I look forward to seeing you next time.